Alright, guys, this is another episode. Today we're going to be talking about the circular flow of income. So, when we talk about the circular flow of income, it is a situation whereby income change ends. You understand? We have the two-sector model that involves the household and the firms. We have the three-sector model that involves the household, the firms, and the government. Also, we have the four-sector model that involves the household, the firms, the government, and financial institutions. For instance, the central bank. So, but we are going to be discussing about the complete sector that even involves the foreign exports. Which involves the household, the firm, government, banks, and the what? Foreign the exports or imports. Yeah. So, the foreign sector. Let's start with the household. Now, one of the things that the household, provide in the economy is labor. And when there's a short in labor, the firms are not going to produce much. Don't forget that the household provides lands, they provide labor for the firms, while the firms produces the goods and services, for the households, which means that household is being paid for the land and the labor that they provide. Meanwhile, the firms pay the household for the services, for the lands and labor that is being issued to the firms, while the household pay for the goods and services that the firms have produced. Now, the government serves as an intermediary between these two persons, the firms and the household, because they don't want extortion. They want labor to be paid well. They want goods and services not to go much above the roof, in order to curtail inflation. That is when the government comes in. The government comes in, to tax both the household and also the firms, so that they provide infrastructures for the firms so that it will make their production much more easier, and at the same time make the labor of the household easier. They provide infrastructure like electricity, like water, like good road networks, bridges, so many infrastructure that will transportation that would help the firms to give the best so that the household will not suffer. So that is what the government does. And how does banks comes into play to make it the three-sector model, the four-sector model? I've talked about the firms, I've talked about the household, I've talked about the government. Now the banks comes in, and the bank serves as the financial institutions between the government, the firms, and the household. Now, income that is being received by the household is paid by the firm. The firm pays some money to the households in form of labor and land, while the household, save in the bank. The firms too save in the banks, and this money is being loaned to the firm, to produce more and also pay tax to the government. So this is what we call a circular flow of income. It rotates between these four sectors. You understand? So that is why it's important that you understand all these things. So the government actually does what we call quantitative easing, and sometimes they do what we call quantitative tightening, which means that in order to get everybody involved, make the economy grow, what the aim of the household is to earn money, for their labor and land. The aim of a firm is for the firm to be existing for such a number of years, or not for to be a going concern, while the aim of the government is what? Economic stability, full employment, economic growth, price stability, and balance of payment equilibrium. That is the full aim and objectives of the government. And when they provide all these things, it provides a platter of gold for the firms and the household to work on softly. So one of the tools that they use, to make sure the economy is okay, by they use what we call quantitative easing, which means that they print more money to the economy so that the firms have more cash, from the bank, so that they can produce more to the household. And sometimes they buy bonds, from the, from both the corporate organizations and the firms and the household. If they want to ease money in the economy, that means they want to flood the economy with enough money. So if there is no much money in the economy, they do what we call they buy bonds, from the companies or the corporate organization, the firms, and also if they've issued shares, if they've issued bonds to the households, they buy the bonds back so that there will be money in the economy. And also they also cut or reduce interest rate so that the economy can boom. There will be what we call economic growth. At the same time, they use what we call quantitative tightening, such that they sell bonds. If if there's too much money in the economy, there's going to be inflation, and this inflation, affect the price stability. Don't forget I talked about the aims and objective of government is full employment, price stability, economic growth, and balance of payment equilibrium. For every of these aims that the government want to achieve, they have a tool that they use to manage it, so that it doesn't go to the extreme. So quantitative tightening, that means when they sell bonds or maybe they increase interest rates, so that means they want to tighten. There's too much money in circulation, and prices of goods and services are going up higher than expected. They sell bonds so that they can tighten the economy, to take money from the economy, so that the economy, because when there's too much money in the economy, then nobody is going to price anything, because you have the money in excess. You can just pay for any amount of money. So at the same time, the firms are going to keep increasing the prices of goods and services. So it's a financial seesaw that we need to. The government is just there as a watchdog to manage all these things. So, and when we bring in the foreign sector, we talk about exports and import. When exports is more than import, we have what we call surplus. But once there is imports more than export, then there's what we call deficit. So balance of payments deficit, balance of payment surplus. When export is much more than import, we have balance of payment surplus. But when there's balance of payment deficit, that means that there is much more import than export. So that is the way the flow of income, circular flow of income is. And we talk about injections that the government puts into the economy. Savings is an injection from the household. Tax is an injection from the government. Also import. You understand? Leakages, which is investments, government spendings, and export. That means the money are going out of the economy. When we talk about leakages, when you invest in some funds outside the country, government spendings and export, these are leakages. Money are going out of this circular flow. You understand? The money are supposed to exchange and in between the firms, the household, the government, and the banks. But if the money goes out of all these sectors, then that's what we call leakages. But if the money goes in, which is injection, you have savings, you have taxes, you have import. So it's still in the economy. You understand? The equilibrium means when there's the leakages is equals to the injections. So that means that the injections and the leakages are equals to each other. So this circular flow of income literally means that the economy the government have to make sure the economy is in stability. So they serve as a watchdog in between the household, the firms, the banks, and the foreign sector. So that is what the circular flow of income talks about. So I'm going to see you guys in another episode. All right, take care. Bye bye.